Welcome to the Explainer. Q1 2026 was, let's face it, a real nail-biter for the banking sector. The interest rate crunch had almost everyone sweating bullets. But then you look at WSFS Financial, and they didn't just survive it, they completely crushed their earnings. So today, we're diving straight into the exact strategic pivot that made this impressive beat possible.
Okay, quick roadmap for us today. We'll hit the top-level highlights first, talk about that nasty interest rate headwind, look at how they drove growth through fees, pop the hood on their loans and asset quality, and finally, explore how they are rewarding shareholders.
All right, Section 1, top-level financial highlights. Let's look at how they beat the odds. We have to start right here with the big one, $1.68. That is WSF's core earnings per share for the first quarter of 2026. And guys, that is a massive 17% sequential jump right from Q4 of 2025. Now, when you're analyzing bank earnings in this kind of volatile environment, a quarter-over-quarter leap of that magnitude, that immediately tells you something highly effective is going on beneath the surface.
And honestly, it was no accident. We pulled this quote straight from the earnings release because it perfectly captures management's playbook. We optimize ongoing franchise investments and grow market share across our diversified businesses. And man, did that optimization pay off. Thanks to this highly diversified approach, they managed to hit a solid 1.61% return on assets, basically threading the needle in a very tricky economy.
Moving to Section 2, the interest rate headwind. This is the core conflict of the quarter.
So that awesome earnings growth we just talked about, it definitely did not come the easy way from traditional banking. This perfectly illustrates the fundamental tug-of-war happening inside the institution right now. Traditional net interest income actually shrank by 1% this quarter. But look at wealth and trust fees. They exploded, up a robust 25%. It's a textbook example of a bank leaning hard on one specific strength to counteract a massive drag in another area.
Now, why did that traditional side take a hit? Well, compressed loan yields and rising debt costs absolutely squeezed their traditional net interest income. You had industry-wide rate volatility actively working against their core lending business. The fact that they still pulled off a profit beat makes this overall operational performance really stand out, especially compared to regional peers who rely entirely on those loan yields.
Which brings us to Section 3, driving growth through fees, the absolute hero of Q1.
This is where their strategic pivot just shines. They built this incredible revenue defense using broad-based double-digit fee growth. Overall, core fee revenue jumped 11%. Digging into that, you've got that 25% year-over-year jump in wealth and trust we mentioned, and, get this, an incredible 46% spike in WFSS institutional services. By aggressively shifting toward non-interest income streams, management completely balanced the scales against broader rate pressures.
But you don't get those kinds of percentages without a huge foundation. WSFS tapped into an incredible $97.6 billion in assets under management and administration. By leveraging that massive pool to generate fees, they basically built a fortress around their bottom line to protect against interest rate volatility. It's a structural advantage that takes years to build, but it pays immediate dividends when margins get compressed.
Let's transition to Section 4, loans and asset quality. Let's look under the hood.
If we look at their loan portfolio as of March 31st, their strong commercial base really jumps out. Commercial and industrial loans, or C&I, make up 37% of the total. That is nearly $4.8 billion. Add in another 30% from commercial mortgages, and you're looking at a 67% combined weighting just in those two sectors alone. This is a highly targeted, business-focused lending strategy anchoring this $22.1 billion asset institution.
Now, naturally, with a heavy commercial load in a tight economy, you might be a little nervous about asset quality. But the data here is actually super reassuring. Their asset quality remains stable. While the sources did note a minor uptick in non-performing assets, the overall volume of total problem assets actually dropped to $503.9 million. That's a great sign of a healthy underlying portfolio and tells us their underwriting standards are holding up nicely.
So, we have a stabilizing loan book and surging fee revenues. It really begs the ultimate question that analysts are asking right now. Is WFSS a buy? Let's take all this operational data and figure out what it actually means for the investors holding the stock.
Which leads us perfectly into Section 5, rewarding the shareholders, the ultimate payout.
Listen to this, because the board's capital return program is incredibly aggressive right now. They just announced an 18% dividend increase, bumping it up to 20 cents a share, alongside a brand new 15% share repurchase authorization. And they didn't just announce it. In Q1 alone, they bought back $85 million in stock. That is roughly 2.5% of all outstanding shares, gone in a single quarter. That's an undeniable signal of management's confidence in their capital strength and future cash flow.
You know, it's pretty wild to think that WSFS has been continuously operating since 1832. They are literally one of the 10 oldest banks in the entire United States. But instead of just resting on their history of traditional lending, they completely modernized their revenue stream. They pivoted to dynamic wealth and trust operations to offset modern macroeconomic headwinds. They adapted.
Which leaves us with a really fascinating thought to chew on. Is this fee-heavy strategy the future blueprint for regional banks trying to survive a volatile rate environment? Did WFS just crack the code? It's an incredible pivot that sets a seriously high bar as we look at other bank earnings this season. Thanks so much for joining me for this explainer, and as always, keep questioning the data.